Good morning, everyone. This is the weekend update. Looking at the Dow daily chart, it's been a roller coaster over the last few days, to say the least. We had the market down 100, then up 160, then, of course, the plunge on Thursday where we dropped 260, and then, of course, yesterday, 210-point rally before we had a dip late into the day. You know, it ended up being that Thursday sell-off, as we surmised in the chat room, was pretty much bullcrap. They used it to, or economic data, to take it down by just spinning the headlines, and then, of course, everything is fine and dandy come Friday. We have a double bottom in place. The inverted head and shoulders that we've talked about quite a few times is still in play, but we need to hold the 50-day moving average now. We had that double bottom at 16,937. We tested it twice on Thursday and Friday. So, you know, we could see, if we flip over and look at the 15-minute chart, given the size of the move and the late day dip we saw on Friday after that huge advance, a little bit of a sell-off. You know, we could see 50, 75 points, even a 100-point downside move, and we'd still be okay on the Dow charts. We've got this bullish falling wedge in place. The breakout is that 200-day moving average on this time frame, so that's 17,150. Now, a couple of very interesting stats just to add to the bullish case, and I know it's crazy talking about a bullish case, but Thursday is what they call a 90% down day. 90% of stocks in the market were down, and down on decent-sized volume. Stats going back, I believe it's over the last 40 years. I posted the link in the chat room on Friday. The average gain the following week after a 90% gain is about 1%, and 3 months later, 4%. Now, over the last 2 years during this bull market, those gains are even bigger. 1 week, 2 weeks, and 3 weeks later, the market is up 1%, 2%, and 3%. And 3 months later, it's up 8%. Now, you recall we've talked about some other very bullish stats on some videos over the last couple of months. We've got the 6-year presidential cycle that says the market rallies on average year 6, 23% into year end. We also have a couple of other stats we've gone over, and everything points to things looking very, very well into year end. Now, there's a lot of negativity out there. Shorts are on top of anything that moves right now, and as I've repeatedly said, that's fantastic. When you don't see shorts anywhere anymore, that's when the top is in, not when everyone's calling crash, etc., etc. Dow Transports, our leader, continues to hold that 50-day moving average. If you look down here at the Dow Transports, we dipped under stochastic 20 and bounced up. Now, the last time we had that bounce up after a sell-off, a week later, we are 300 points higher. If we go back to the other instance where we touched the 20 level back in June, a week later we were up 300 points. So if we step back and ignore all the noise that you hear out on the mainstream media, things look good right now. I know it doesn't feel like that. McClellan Oscillator, as we surmised on Thursday, ended up dropping, almost got to that negative 80 level. That is another good indicator for the medium term. This is a great bounce level, as we've seen over the last couple of years for the market in general. Small caps, a little bit of a bounce back, but small caps continue to be the ugly stepchild of this market. Absolutely hated. Now, the only things, as we know, that are moving in small cap land are crappy stocks with news or crappy low float stocks with news. Anything, as we call them, fat ass stocks with any sort of decent sized float. It may move a couple of cents, but that's about it. I was laughing about some tweets I saw on Friday on Twitter regarding, I think it was LIQD, and people were talking about, hey, this stock is soaring, and then you look at it, and it's up 8 cents on the day. Now, granted, recently in this kind of market, an 8-cent move on some of these stocks is actually fantastic, because the hot money, all they want are stocks that are up big, the low floats. And we actually had a couple of those this week. We had Ford on the Apple smartphone case on Thursday, gave it up on really low volume on Friday. We had RIT earlier this week into the cyber IPO that gave us a fat little move, but it's done a full retrace. Now, the reason I'm pulling these charts up is I wanted to show you something we're looking at. A lot of guys in the chat room have asked me, when these pull back, do we add to positions? Do we pick up more? My answer has been every single time, volume. We follow the volume. I would rather us pay slightly higher or even higher on a stock like this, these low float stocks, on a volume push, then grabbing it on a retrace on low volume. And these are stocks that move in volume. Let's look at the king turd for this week. That was CNET, that keeps pumping out really nonsensical press releases, but it's a low float. The algos are on it, and the volume is big. And what you'll see if you look at a lot of these big movers is you have a big up-day move on volume, continuation the next day on volume. That is the key thing, continuation the next day on volume. If we look at RIT, we had that decent-sized volume move on Friday, and then the big continuation move on, actually that was Monday, and then the continuation move on even bigger volume on Tuesday. And then the next day, that gap pop up into the IPO and retrace. Now, ones that haven't done that, we had Ford, we had that big volume move. Next day, we didn't get that volume when we had the retrace. So volume is the key on these, and it tends to be, once we get volume over 4 or 5 million, you know the robots are latched onto it. And as we've seen on CNET recently, when the volume gets over 10 million, and a recent example other than this was, of course, NETE. When you get the volume over 10 and they start to run like this, typically they run for a couple of days. And when they start to do that pullback, the pullback is usually on much lower volume. As you can see here, we were doing 20 and almost 40 million shares. Pullback on a quarter of that volume for 2 days, and then a fat rebound on an increasing move on volume. So playing these low floats, this is how we need to approach these plays. As I've mentioned a lot of times, we could play 5 low floats right now, and maybe one of them will do this. But if we approach them correctly, just getting that 1 out of 5 on the kind of moves that these put in could make your month and your week and your year if you play them correctly. On stocks that move big, even though we're looking for big moves, you don't put large positions into these stocks. You move into them small, they start to rip, you automatically book some gains. Just because we're playing the low floats now does not mean we go away from our strategy. We don't ride and hope to get the absolute top. We piecemeal them out as they move up and keep a little piece, and then if the volume comes in on day 2, day 3, you can always pressure bet, add back with stops, etc. So this is how we're going to continue. I mean, the low floats are still the only game in town, and a lot of the larger float, small caps are just dead right now. We talked about a couple of scenarios that are likely happening. We're seeing probably some early year-end tax selling in a lot of them, which could mean a rebound is coming soon. But, you know, while this is the only game in town, this is what we have to play. We got to play them smart, play them small because the moves are big, and look for these patterns that a lot of these stocks are starting to exhibit right now. That's it for the video, guys. Any questions, shoot me an email, feedback, BuySellShort.com. If you've got any questions on positions you're sitting in, positions you're looking at, anything, give me a buzz. Love answering those questions. Have an awesome weekend, and see you all in the chat room on Monday. Bye.